Well, hey folks, and welcome into F3, our third Friday of the monthly webinar, Family, Friends, and Finance. I am Peter Richon with Richon Planning. If you know me by now, fantastic. If not, we'll get to know each other a little bit more over this educational webinar series where we focus on a different financial topic each month. And we've talked about generating retirement income, understanding retirement income. This month, wanted to talk about a different pillar of our optimized retirement plan, which is taxes. When you generate income from your investments, taxes are going to be kind of a natural result of that. And our goal as individual savers and investors, and certainly as planners and advisors, is to try to help to control and minimize those tax liabilities and implications, not just in one year, but over your lifetime. So we're going to be talking about one of the tools, one of the best strategies that we have available to us to control that lifetime tax liability through strategic tax planning and Roth opportunities. So that'll be the focus of today's webinar, understanding those Roth opportunities. And there was an old song, More Money, More Problems, and it's been a saying for a while, but I wrote an article that appeared in Entrepreneur and Fortune magazines, and it was titled, Wealthier People Make More Costly Tax Mistakes. Our tax system is progressive, so the higher your income, the more assets you have, specifically in these tax deferred accounts, ultimately, the more you are going to be paying in your lifetime tax liability, and the more costly it is to ignore the opportunities that we have right now to control our taxes and minimize them. You know, the IRS has a plan. They've got a default plan for collecting as much as possible from you. That is an optional plan, however. You can enact your own plan and oftentimes bring that tax liability down. And so that's what we'll be talking about today on the webinar. Once again, I am Peter Richon, and if you would like to join future webinars or be in touch with us at Richon Planning, just drop us a line. You can give a call. You can text your name to 919-300-5886. You can email us info@richonplanning.com or my email peter@richonplanning.com. You can visit the website and be in touch that way. A lot of different ways to be in touch. If any of this information interests you, you have questions following up on it, love to hear from you. Help out any way we can, provide you with good, solid guidance, education, information, and maybe, a relationship in advising. But we'll go ahead and get started with the information for today. And forgive me, gotta switch screens here and make sure that this does go up. All right, it looks like we are going. All right, so your optimized retirement plan is what we put together at Richon Planning. Before we do get started, of course, some disclosures, disclaimers, is that don't take anything that is generic in nature, meant for a wide audience, as specific advice for you. Don't act on anything that you hear without consulting with your individual financial professional, legal, tax, financial advice. And this is not meant for any of those. This is informational in nature. Your optimized retirement plan, we believe, should consist of income, investments, taxes, healthcare, benefits, and legacy. All of those things should be addressed. Most of the clients that we encounter have done a good job in earning an income and getting money into investments. But everything changes when the direction of money changes, including the tax implications. In fact, everything changes as the direction of money changes. When you retire, you no longer have a paycheck supporting your investment plan. Now you have investments that need to support your income plan. Taxes result from that. Your healthcare expenses are going to be determined by the taxable income that you have, and ultimately, we do want to leave behind as efficient a legacy as possible. No one wants to leave the IRS as their largest beneficiary unnecessarily. So all of those things really need to be brought together into a cohesive, comprehensive plan. Most of the people that we talk to have not had the conversation or the big picture bringing all of those things together. But today, again, we're going to specifically be talking about taxes and the tax implications and the opportunities. So, number one, from a very high level, what is a Roth IRA? Well, it is a qualified retirement account. That means it is specifically earmarked for retirement purposes, and by doing so, it qualifies for some tax advantages. The Roth IRA specifically, as opposed to the traditional IRA, is with after-tax contributions, meaning you pay tax before the money goes in. You do get tax-free growth and tax-free qualified withdrawals. So that is the basic premise of what is a Roth IRA. Now, why does that matter? Well, it does provide for more flexibility and control. And these are important factors for retirees. The tax-free growth in the income is obviously what we hear about when Roth IRAs are discussed. However, there are many additional benefits that I don't think are discussed or focused on enough. So why do Roth accounts truly matter? In addition to the tax-free growth and income, they also will provide reduced health care cost potentially, both before and during your Medicare years. A reduced RMD amounts and control of your tax brackets. Remember, required minimum distributions, RMDs, are the IRS's plan to collect from you based on their predetermined method of collection and usually collecting the most. These are required distributions. It's basically a minimum payment to the IRS, but if you fall into that plan, defer and default de facto, you are in fact enacting the IRS's plan in their best interest. Most people want a plan that is in their own best interest. So we can do that and control tax brackets by reducing those RMDs. It will reduce taxable withdrawals if long-term care is needed. So if you've got these exorbitant long-term care expenses later in life and you have to draw that money out of an IRA or a tax-deferred asset, well, not only is it $10,000 a month for the care or however much it is, these are pretty high expenses, but now you've got to account for the taxes on top of that. So it might be $13,500, $14,000 a month that you are drawing from these accounts. It can control the widow's penalty, and this happens for a surviving spouse. When one spouse passes away, the income levels drop. Generally, at least one stream of income, Social Security, is reduced. One person only gets one check, so the lower of the two Social Securities is going to disappear. Oftentimes, it's even more substantial than that, but at least the Social Security is going to be impacted. Simultaneously, though, the married filing jointly tax status goes to single filer, and all of the bracket thresholds come down, meaning the amount of tax paid on the same income goes up, and your IRMA brackets also are reduced from married levels to single levels, meaning that your health care premiums would be more expensive with the same amount of income. A Roth IRA can help control or eliminate that penalty on a widow. And then a tax-free legacy. We don't want to leave the IRS as our largest beneficiary. I'm not sure that everybody has aspirations to leave behind a huge amount of wealth, but if you've got a plan for your lasting financial confidence, then more than likely something is going to be left over. Why not leave more efficient assets behind so that the IRS does not become the biggest recipient and beneficiary from the hard work that you've put in? Leave that money more to your loved ones. There are certain assets that are better to be left behind than others. Now, with that legacy piece, that final one, yes, Roth IRAs are still subject to the 10-year distribution requirement rule. So even if you leave a Roth IRA behind, you prepay the tax during your lifetime, you pass away, you leave a balance to your kids, then they are required to get that money back in taxable circulation within 10 years. The distributions won't be taxable, but they do want that money back into the system to be taxed again. The advantages of Roth IRAs, therefore, no lifetime RMDs, tax-free income, tax flexibility, legacy planning, the reducing of potential legislative risk. What do I mean by legislative risk? Well, Congress can change the laws on our retirement accounts. What if tax rates were to go up into the future? And as you can see on your screen here, the top marginal tax rates have been very volatile and much higher than they are today. And in fact, the average tax rates today would need to go up about 30%. Our tax rates today would need to rise about 30% to just get back to historical average rates. So we are in a low tax rate environment today. And I hear a lot of people kind of kicking themselves for not taking advantage of Roth opportunities sooner. Building up a tax-deferred retirement account balance has not been a mistake. That has been a good thing. Tax rates have come down. The amount of income that it takes to fill up our brackets have gone up substantially. And in retirement, people are finding that maybe they're not dropping tax rates and brackets, but building up that account in a tax-deferred manner. Don't kick yourself for that. That has been a good thing. It's just now is time to shift the paradigm and look at planning how to manage the tax liability that has been built up in those accounts. So you've done a good job in building that. Don't kick yourself. Hindsight being 2020, we can look back and say woulda, coulda, shoulda. But the Roth wasn't even available during much of this working career that most people have built up these tax-deferred accounts over, and certainly wasn't available in the 401ks until much later. So the potential drawbacks to a Roth IRA, yes, there are drawbacks. Everything does. Where there are benefits, there are also drawbacks, pros, there are cons. The Roth is no exception. So no upfront deduction. When you're putting money in, you do not get an immediate tax deduction. There are income limits and limitations, and there are contribution limits to the Roth IRA. Those rules are as follows. For 2026, the Roth IRA has a standard contribution limit of $7,500. Now, if you are over 50 years old, you get an extra $1,100. You can get up to $8,600 in. But there are income limitations. You can only put money in if you earn between a certain amount. You have to earn as much as you put in, and you can't earn over certain limits. You must have newly earned income of greater than or equal to the contribution amount that you are contributing, but not over the limits for Roth IRAs. You got to kind of be in that Goldilocks zone, not too hot, not too cold, but just right. For Roth 401ks, these are direct payroll deductions. The limits are much higher, and there are no income limitations. Obviously, if it's a direct payroll deduction, then at least you're earning enough to make the contribution. So that requirement is satisfied. And there is no income limitation. So high income earners sometimes say, well, I can't get money into a Roth. But then we look and there's a 401k there available. And even if there's no match on the 401k, maybe it makes sense to utilize that for the ability to get new money, new dollars contributed to Roth. So if you are 49 or below, the contribution limit is $24,500. These are also much higher contribution limits inside of the 401k. If you are over 50, you've got an $8,000 catch-up. That brings it up to $32,500. And between the magic ages of 60 and 63, the contribution limit is even higher. You get an $11,750 catch-up. So your total amount that you could contribute to a Roth 401k of your money, not including any company match, which, by the way, they will match, but it usually doesn't go in on the Roth side. You could contribute up to $35,750 between those magic ages of 60 and 63. Now, why does it end at 63 is kind of a weird age there to end that. All these retirement ages seem a little arbitrary, but there is kind of a method to this one, because at age 63, then you are looking at 2 years until Medicare, and IRMA will look back. So they kind of want to see more taxable income thereafter. So anyway, no income limitations, And new for 2026, so this is an asterisk here, new rule for 2026. If you are a high income earner, which means you're earning $150,000, you as a single individual, not household income, but a single individual, if you are earning over $150,000, then your catch-up contribution must go in on the Roth side. And this one makes sense, right? The government is trying to collect the most, so they kind of say to themselves, well, if somebody is in this window where they're earning that much and they're able to contribute this much money over and above regular limits, but even using the catch-up provision, then obviously they're living below their means. And there's a likelihood that they'll be in a lower tax bracket in retirement. So force them to make the Roth contributions now. That way we get to collect at these higher income levels. I think there are pretty smart people behind the register of the IRS that have figured out these things long ago and try to figure out how to collect the most. That said, what are we doing when we make Roth contributions versus pre-tax contributions? Well, we are prepaying tax, but we're also buying ourselves extra time in retirement. And I'm going to take it with a grain of salt, what they've told us to be true, that we will be in a lower tax bracket once we retire. I am not convinced that that is true, certainly not universally true, but let's just take that at face value. We've been told you will be in a lower tax bracket when you retire. So they told us to defer and delay paying taxes on our retirement contributions in our 401ks. Let's say we were in a 25% tax rate. I know that's not actually one of the brackets, but just for round numbers, go with me here. Let's say we are in a 25% tax rate. We've got 25% during our working career, and our goal is to get $10,000 put away into our retirement account. Well, if we are using a traditional 401k, we put that $10,000 in, we don't pay any taxes, $10,000 goes into the account. Let's say we did that for 10 years and had reasonable returns while we were doing it. So we put in $100,000, we had good returns, and that doubled to $200,000 in 10 years. Not bad. We've put in $100,000, we didn't pay any tax, and it turned into $200,000. Well, what happens if instead we did that on the Roth side? Well, again, our goal is to get that same $10,000 contributed to our 401k. In a Roth 401k, we would actually have to pay $3,333 if we are in the 25% tax bracket. And then $10,000 would go in. So we would have to have earned $13,333. We pay our tax, and the same $10,000 goes into the account. Now, we do that for the same 10 years. We've contributed $100,000. We've paid $33,333 in tax, and we have the same $200,000 in the account. Now, what happens next? We retire and we start making withdrawals. And we've got two sides that we are comparing here. On the pre-tax side, if we needed $40,000, and remember, I'm imagining that we do drop tax rates in retirement. So if in retirement we go from the 25 to the 20% tax rate here, and we need $40,000, well, we don't pull out $40,000 because we have not paid tax yet. We'd have to pull out $50,000. And we can pull $50,000 out of our $200,000 balance 4 times. So we've got 4 years of withdrawals and our $200,000 is used up. And we have paid $10,000 a year in tax over 4 years. So in retirement, we paid $40,000 in tax in a lower tax bracket for the $33,000 that we saved, air quotes there, while we were working and earning a paycheck that we could have paid it with. So not only did we end up paying more because of the growth of the account, but if we were making those withdrawals from a Roth IRA, if we needed $40,000, we only pull out $40,000. We don't have to pay any tax because we already did that when we were working and earning an income. And so we actually have a full extra year's worth of income in a fifth year. We have bought ourselves additional time. We've also paid a bill out of our income while we were working rather than having to budget that bill out of a finite amount of money after we've retired. And so, again, even if we drop tax rates in retirement, if the goal of your investment is growth, so is the IRS's. They appreciate the growth on your account because they get to collect more down the road. Again, they figured this out a long time ago. But wait, there's more. That's not all, because in retirement, your income actually dictates and determines the taxability of several other elements. Chiefly among them, the Social Security income that you receive. So if you are an individual in that same situation collecting $2,000 a month, well, that would make your income from Social Security 85% taxable. So $2,000, 85% of that is $1,700. And if $1,700 goes into a 20% tax rate, that means that your net benefit is $1,660 from your $2,000 gross Social Security benefit. If you're married, that same amount of income, and again, married people have slightly higher rates and brackets here, that same amount of income would mean that your Social Security is only 50% taxable. Well, that means that your $3,000 a month of combined Social Security only nets you $2,700, and you're paying $3,600 a year in tax on that Social Security income because you deferred and delayed paying taxes during your working career. If we prepaid and got that money into a Roth, we get to keep all of our benefit and pay no tax on the Social Security in retirement. So this is a double whammy in the wrong direction here. So what are the strategies to get money into a Roth? Well, we could make just direct contributions, which is very valuable. We talked about that opportunity. You've got to make at least enough that you can contribute. You can't make too much. And there is a way to get money in for two spouses if we want to get a little bit more, or use those Roth 401ks. But what if we're income eliminated? Well, then comes the backdoor Roth strategy. Non-deductible IRA contributions followed directly by a Roth conversion. This is really specifically for higher income earners who are income eliminated. Definitely try normal contribution methods first. The Roth 401k is an option if you've got that available. Certainly that's a great place not to have to mess with the complications of the backdoor Roth strategy. And if you don't know if you're income eliminated, if you're kind of right on that threshold, consider making non-qualified investment contributions during the year. And then once you've seen what your income is for the year, you can make a contribution all the way up until April 15th for the previous year and then do the backdoor conversion method. So last year's contributions would be this year's conversion. But because we're not getting a deduction, the conversion not taxable, it's basically the same as making a direct contribution to a Roth. Now, here is an important, very important element of the backdoor Roth strategy, is that the IRS uses what's called the pro rata rule. They look at all of your IRAs in the aggregate. So my analogy here to understand what this means, if you've got two glasses of water, and one is full, one is empty, and you transfer the water from the full glass to the empty glass, it's very easy to identify that this is the water that made it over into this glass. It is isolated. But if first you took that water and dumped it into a pool and then pulled the cup back out, it's very hard to say, well, this is the exact water that made it over into the second glass. And that's basically the idea behind the aggregate or the pro rata rule, is that the IRS is saying if you have an existing balance, you need to completely convert that before the backdoor method to contribute new dollars. So don't if you have an existing balance in your IRA, don't be too aggressive with the backdoor method until you have converted and cleared your existing balance. Otherwise, the IRS is going to say only the percentage, only the portion that represented that new glass of water is what is considered the back door, and the rest of it would be taxable. And then it is a nightmare of tracking numbers from that point forward. So understanding that pro rata rule, really all IRAs are aggregated. You can't isolate an IRA to have, a standalone glass when you also have a pool of water over here. But what you can do is you can use the money that you would have contributed this year to, instead of making new contributions, let's use those dollars to pay to convert over and clear an existing IRA balance and then begin new backdoor contributions. There is also something called the mega backdoor Roth, potentially moving tens of thousands of dollars annually into Roths. The strategy does rely on filling kind of a space between your standard 401k contributions and then the maximum overall limits. It's a two-step process. You wouldn't get a deduction, but you don't get deductions for putting money into Roth IRAs. So that part is not really a detriment if this is done correctly, if you have the opportunity. The goal is to make, maximum after-tax contributions. And once you've maxed out your regular pre-tax IRA or your Roth 401k, and I misspoke there, pre-tax 401k or Roth 401k, then you can contribute non-Roth after-tax money to your workplace plan and then immediately convert it or roll it over to your Roth IRA. Now, the IRS does, set some limits on this. They are much higher. That's why it's the mega backdoor. The total plan limit in qualified plans is $72,000. You've got the catch-ups there. Again, if you're 50 or above or between 60 and 63, depending on the catch-up rules. And you'd have to do a little bit of math to figure out, because the company match is included in that total limit. So if your company is matching, you've got to deduct that from what you can put in. It also has some critical prerequisites for that mega backdoor conversion. Your employer's plan is what you're using there. You have to have the option to make non-Roth after-tax contributions, and you have to have the ability in the plan to do in-service withdrawals to a Roth IRA or in-plan Roth conversions. So those are the two major prerequisites there. But that's for getting new money into a Roth, which I think is a valuable thing. More people are understanding just how valuable it is to prepay your tax, be done with the tax, let the growth happen tax-free. However, what we are seeing very often is people who already have this large existing tax-deferred balance. Well, Roth contributions and Roth conversions are two different things. And Roth conversions are for people who already have that large tax-deferred balance. It actually creates even larger Roth opportunities. So look at conversions rather than contributions if you already have that large balance. It does allow you the opportunity to begin controlling your tax liability and transferring that tax-deferred balance to control future tax brackets. There are no conversion limits. You could do as much as you want. Now, we'll talk about whether or not it's smart to do that, but there is no limit on the amount you can convert. If it's already in your right pocket, in your tax-deferred accounts, the IRS does not care if you were to move all of that over to your left pocket into your Roth accounts. But again, that might not be the smartest way to do it. There are no income restrictions or requirements. So there really is a lot of flexibility and opportunity there. Now, the question I do get, should I just convert the whole thing? Well, oftentimes it's better to fill up your tax brackets over multiple years, because We have a progressive tax system. So if you're already in a nice, very low tax bracket, maybe not the 10, but maybe the 12 or even the 22, you would not want to voluntarily push yourself into significantly higher tax rates and brackets, maybe experiencing IRMA and certainly costing more than is necessary optionally by converting over more than you have to. So there was a guy once upon a time who had it about right. His name was Bob. And Bob on The Price is Right would always try to get as close to the number without going over as possible. We call that maximizing your tax brackets. If you've got a nice low tax bracket, and by the way, the day after you retire, for that period where you no longer have a paycheck, those are probably your lowest income requirement years. Now, you might be doing some optional spending, but as far as your taxable income, those are probably the lowest income years and represent a great window of opportunity. Not that you shouldn't do it while you're working, not that there isn't an opportunity later, but we want to try to utilize the lowest tax rates and brackets possible. I do also get the question, well, what about the 5-year rule where if I convert, I have to wait 5 years before using the money? Now, little known secret of the Roth is that the original contributions can be pulled out anytime. The government wants that money back in taxable circulation. So you can pull out the original contributions, no tax, no penalties at any point. You don't even have to be 59 and a half to do that. But if you pull out the growth, that's where taxes and penalties can come into effect. However, the value of a Roth conversion, where I get asked this, well, what about that 5-year rule? From people who are already past 59 and a half, who are looking, at managing taxes in retirement. They ask me, well, what about that 5-year rule? The value of the Roth conversion is not in the conversion itself. It's not in the moment it happens. You're optionally prepaying tax in that moment. The reason why you would want to do that is all the tax-free growth that happens thereafter. So if you are looking at certain dollars and saying, these are dollars I might need in the next 5 years to spend, then I wouldn't likely look at a Roth conversion. On the other hand, if you are looking at dollars and you're saying these tax deferred dollars are clearly ones that I will not need for at least 5 years or more, those are the dollars that it would be appropriate to consider the Roth conversion because you'll get to benefit from the value. So again, it's actually less about the 5-year rule and more about the fact that if you're not planning on waiting at least 5 years, a Roth conversion probably doesn't even make much sense. Now, how do you pay tax on the conversion? Ideally, you want to use outside cash. There's kind of a good, better, best. Using outside cash to pay for the tax on the conversion, which is a taxable event, obviously. It's taxed just like you took a withdrawal, just like income. But using money that you have outside of the retirement account is the optimal way to do this because the goal of the conversion is to get as much over into the Roth account as possible. Also, if you had $10,000 in the bank and it grew, you get a 1099 INT. You get taxed on that growth. If you have the same $10,000 over in a Roth and it grows, well, that's tax-free growth and future tax-free income or inheritance. So the growth of the same money inside the Roth is more valuable. So try to preserve that value as much as possible. Use outside money that you've already paid tax on, cash, non-qualified money, to pay the tax on the conversion so that more gets into the Roth. Now, it can be paid, not quite as optimal, but the tax can be paid with money from within the converted amount itself. It's considered a taxable distribution, and that money obviously goes to the IRS out of the account. It comes out, there's less that goes into the Roth. Caveat on that, if you are younger than 59 and a half and looking at those Roth conversions, do not pay the tax with money from inside the existing balance. That is considered an early withdrawal. So in addition to the tax, there would be a 10% penalty on the amount that you send to the IRS. And who wants to be penalized on money they just optionally chose to send to the IRS? So again, good, better, best. You can pay it with money from inside, but the best way is absolutely to pay it with after-tax cash. I did speak about the healthcare and widowhood planning. Roth assets can vastly improve tax flexibility, and also I do think we need to be cognizant and aware of IRMA thresholds. This is one of the big questions with Roth conversions because our healthcare premiums in Medicare are determined and dictated by our amount of income. So if we do a large Roth conversion, that counts as taxable income, and it can cause our Medicare premiums to become pretty significantly higher. It can add a good amount of additional premium cost to those Medicare premiums. And an additional benefit of the Roth is if we have these kind of astronomical long-term care costs, and we're drawing that money out of a tax-deferred account, well, it's not just the long-term care cost, it is the taxes on the long-term care cost and what that long-term care cost could do to our Medicare premium amounts. It could certainly cause us to encounter IRMA. So we need to understand not only our income bracket thresholds, but also those IRMA brackets when we are considering Roth conversions. But the key takeaways here, that Roth equals tax, legacy, and healthcare flexibility. That's what it is. It is a flexibility strategy to control more of the unknowns and the variables. So you should explore Roth opportunities as part of your comprehensive, optimized retirement plan, specifically the pillar of tax planning. Tax planning, I think, is one of the most overlooked and missed opportunities as we have had access to the market and been making investments. Understanding and planning for taxes has been overlooked. So how do we go about this next step with our clients? Well, first, most people can tell me, ballpark, what they have inside of their retirement accounts within pretty close proximity. But very few people have ever looked out and say, well, with what I'm projecting, here's how much I will be forced to withdraw for my RMDs into the future. And that is relatively predictable. We're never going to get the rate of return exactly right, but we can look out and see, based on what we are expecting, how much is the IRS going to require for you to withdraw? And then, is that going to raise your tax bracket? Is that going to raise your Medicare premiums and cause you to encounter IRMA? Does that look like it's going to be the status for the rest of your life thereafter? Maybe we want to look at how to control that sooner rather than later. And again, most people can tell me the approximate balance that they have in their account, but very few people have looked at, based on their tax rate and how much that account might grow, what their tax liability, what their lifetime tax bill would be on that account balance. And that's something we should know, not just how much do I have, but how much am I going to pay in taxes if I default and defer to the IRS's plan. Now, I call this the optional tax plan. And what we try to do is get you down to your mandated minimum. And that is through reallocation and utilization of Roth strategies. Now, oftentimes we can't get it quite to this number, but we can get it a lot closer to this number than what the IRS would prefer you to pay. So again, if you've not looked at this, this is available online. We've got a website, 919retired.com. That is where we put the online retirement tax bill calculator. You can enter in your balance, your age, your assumed tax rate, and you can see what the IRS wants you to pay versus what you could pay if you did some proactive strategic tax planning on your own. And we, of course, can help with that because it's not an all-at-once kind of thing. What we look at is, based on how things are projecting out, what tax bracket are you going to be in for the foreseeable future? And in this case, we are above the 22% bracket threshold for both of our mutual lifetimes. But then when one spouse passes away here and those bracket levels change, we enter in, after the death of our spouse, we enter into the 24% bracket. That's the widow's penalty I spoke about earlier. So we are in a lifetime of 22% taxes on a good bulk of our income. And then after one spouse passes away, we enter the 24%, which also they're not exactly the same number, but just about coincides with where we start paying more on our Medicare premiums. Well, what if we looked at that and said, okay, well, due to the taxes and the expenses, here's your lifetime portfolio value projections. And we see that, for a while it rises, and then after a while it begins to fall because of inflation and expenses. But one of the largest expenses there is taxes. What if instead we were to convert over early? And instead of this lifetime of being in the 22% bracket, and then our surviving spouse being in the 24, what if we can opt to stay within that 22% bracket during our life? And as we go along, we can even control these years that spike up above that and maybe move those down to future years. But then within our foreseeable lifetime, within a reasonable time in the future, we are dropping into the 12% bracket. And for the rest of our joint mutual lifetimes, never going above that. That is a significant savings. And in fact, we can quantify that savings. We can say that we paid $1 million less in taxes by doing this. And it added $2.6 million to our total portfolio assets. What that looks like here is obviously there is a cost for doing Roth conversions early. We have to prepay the tax. But long term, we've added this value to the portfolio. Now, when seeing this, I have people ask, yeah, well, Peter, what if I die right here? I've cost myself money. Well, taxes are pay me now or pay me later. So whether it's in your lifetime or after, the taxes are still owed on these dollars. So wherever we think we go after here, up, down, sideways, the tax implications stick with the dollars that we've saved. So this trajectory of value that is realized from doing these Roth conversions actually survives beyond our own lifetimes. This is the way that it would project out if we lived to 100 or if we passed away at age 80 or sometime before. And so that's why we look at these Roth conversions. We've gained $2.6 million in value by doing these Roth conversions and prepaying taxes in this example. And if you'd like to see this again, we can provide this to you after the fact. At our firm, we look at how do we do this most optimally. Do we convert over everything all at once in 1 year? Do we wait 6 years? Would it make sense to wait a little bit longer? And we can model this out to find out how many years and in what amount should we be converting over bite-sized pieces to pay the least amount possible in taxes on that account balance over your lifetime. And the goal, again, is that we've got income that is paying out to us now. We've got money for the next 5 to 10 years in place, ready to be there. And then the Roth money should be our long-term money. It is one of the most optimal assets to leave behind for next generation. Appreciated non-qualified assets, appreciated real estate assets, life insurance, and Roth IRAs are all kind of our optimal legacy pieces. And it provides you a lot of flexibility. And that is why we bring all of this together: income, investments, taxes, healthcare, legacy planning for the optimized retirement plan. Today, talking a lot about taxes, a lot about Roths, but a lot of people have made a pretty good income, put that income into investments, but have not reversed that course yet. And that's what we help with, in understanding how to bring all of those pieces together. And I hope this provided a little bit of insight for you on the value of tax planning, specifically Roth IRAs and 401ks, the values, the benefits, the advantages, and the disadvantages. There is a cost to getting money into Roth. but a little bit of understanding of why we think this is such an important topic. There is no age where it's too young. There is no age where you're too old. You just need to find your sweet spot for figuring out if, when, and how much making Roth contributions or conversions make sense to you. And if you've got any questions about that, feel free to give us a call at Richon Planning. Be happy to talk it through, map it out for you. 919-300-5886, 919-300-5886. Thanks for tuning in to this edition of Family, Friends, and Finance, F3, our monthly webinar, the third Friday of every month. Sign up if you'd like to see future webinars, get our mailing newsletter, go to our YouTube page. That's where these webinars are housed. Like, subscribe, share, comment with topics that you'd like to hear us talk about in the future. We'd love to hear from you, whether personally or just with ideas to cover for future webinars. Of course, we do offer a complimentary planning strategy session to put your optimized plan together for you. So if you'd like to get that, give us a call, 919-300-5886, or visit online, richonplanning.com. That looks like Rich on Planning, richonplanning.com, and just get in touch with us there. Look forward to hearing from you, helping any way we can. So glad you tuned in for this month's edition of the webinar. Peter Richon here, and I'll talk to you soon. Take care.